the circle jerk of property gurus. There is a growing pattern I am observing in the buyer's agency space that is hugely concerning to me. For as long as I can remember, Australian property has been pushed as the low-risk investment option for wealth accumulators. The story has always been that Australian property is consistent and property markets go through cycles of growth and then flatline, rarely experiencing huge swings that are synonymous with shares and other high-growth asset classes. Why? Well, Australian property is 70% owner-occupied. Our lending policies have historically been strict, and valuations were completed by ethical professionals governed by a strict code of conduct. In short, the banks wanted a lot of security, they added risk buffers, they valued properties conservatively, and as a result, homeowners and investors were safer. In recent times, we've seen the rapid adoption of auto valuation technology from the big banks. This software avoids the need for a human valuer to visit the property, saving the bank hundreds or even thousands of dollars per property. This has created an arbitrage opportunity for certain buyers' agents, capitalizing on this as they profess to look like asset selection gods. The strategy is relatively simple. You find an area that has decent fundamentals and a gentrifying asset type. Lots of renovated or newly constructed properties which now outshine the original properties in the area. Find a property that is in original condition and has no capital improvements. In many cases, the more derelict, the better, as long as it has good bones and doesn't require a full knockdown and rebuild. This property is usually 30 to 50% below the median house price due to the condition. They revalue the property post-settlement using the auto valuation system. This usually will present immediate equity due to the variation from the median house price. The auto val doesn't know that this house is a piece of shit. Renovate the property to the standard of the suburb. This increases rent and also bolts on additional value to the already inflated auto valuation. Cash out and use that to buy the next property at a granny flat, etc. Now, at face value, it seems pretty reasonable, right? Well, here lies the issue. The auto val doesn't represent fair market value. If you put the property on the market, it would be unlikely to sell for the inflated auto val price. As a result, many investors have far less equity than they really think. Those who are at an 80% are more likely at a 90% loan-to-value ratio, and those pushing the pace at a 90% LVR are likely negative equity. At a micro level, it is only an issue if you can't afford to hold the asset and need to sell. If you have bought well, it will work itself out in the wash over time and you'll do fine. But at a macro level, this presents a systemic risk that could be compared to the housing crisis of the GFC in the US. We've got huge property incentives being rolled out, a huge shortage of property across the nation, and now a flawed valuation system that allows people to over-leverage and get dangerously close to negative equity. Now, I am not a property fearmongerer. I love property and I actively invest myself and will continue to do so. However, I urge everyone to be cautious. Understand the strategy that you're implementing, recognize the risk of leverage, keep strong cash buffers, and focus on long-term fundamentals over short-term speculation and arbitrage. Be careful out there.